we're going to get into the picks, and each of these analysts has 3 picks, and I've asked them to take their top 3 picks. And what we're going to do is we're just going to frame this in terms of the market has become more defensive, obviously, in the past, really since October. And I want to bring that theme into these picks because I think naturally a lot of Canadian tech stocks are naturally defensive. And I want the analysts to frame it in terms of has their mindset changed because we're coming off the biggest bull market that any of us have ever seen. And it's not throwing a dart at a wall, but in some cases it's close. So you just pick a stock that's growing and expanding revenue, and you're going to do pretty well. But those days seem to be at an end. So as we go through the picks, I want to the recurring thing that we're going to come back to is looking at a defensive market. So let's start from this side. Kevin, let's talk about one of your top picks.
Sure. I will start with my number one topic. I think right now at this point in time would be Connexus. It is a high-valued stock, but I do think that also in this type of a market, what I am looking for are companies that have a very good recurring, revenue base and also have demonstrated good profitability. And Connexus has done both of that. So this is a great company, a great management team, and really cool technology that helps big, large, complex manufacturers help them optimize and predict what happens to the supply chain at their organizations when there is an adverse effect. At the company, and I do think that that's really important in this environment. Companies are just getting more complex, they're getting more global in nature, and margins are under pressure. So having any kind of insight on your supply chain really is beneficial. The stock did have quite a difficult year to end, 2018 down 15%. That was off of a slightly weak Q3 report where they saw a deal slip. We don't see any issue with that. We think that the deal will come back in the coming quarters. And so what I think that does is it prevents a very good buying opportunity for investors right now. The stock is trading at a discount to peers on an EV sales, EV EBITDA basis. It is trading at a discount. Historically, it has traded at a premium. I do think that a premium is warranted for the name, given that it has subscription revenue growth in a 20% range, EBITDA margins plus 25%. Those are only going to move higher. So I do like the valuation here. And as for 2019, what I'm looking for in terms of trends, number one, the company has been leveraging partners like Accenture and Deloitte to help it sell its services. That's a very good model for them. It really helps them scale the business nicely and profitably with these companies doing a lot of the heavy work. So you'll see more of that. They just signed Ernst & Young a few weeks back as well. The second thing is this company continues to diversify into other industries. It started off in electronics and pharmaceutical type companies, but now you're seeing it move into automotive, CPG, and food and beverage. So I like the broadening out. So I do think that this is a name that will continue to show some good revenue beats, and the stock should re-rate higher.
Connexus is trading right now at $76.76. What's your target?
$100.
$100. Say tomorrow we enter into a recessionary environment. How does Connexus do in that? I
think Connexus still can benefit. Actually, in what I saw, we went to a bunch of analysts went down to their user conference in October, and what we heard was an increasing interest in companies getting interested in the platform, mainly due to issues surrounding like tariffs and trade uncertainty, because it does help these companies really navigate what could happen in a worst case scenario, and it helps them understand how to fill that demand where it might be changing very rapidly.
Any chance you raise your target on Connexus in the coming year? Is there something that would make you re-examine it and go higher on it?
They would have to, really demonstrate much higher than, I do already look at them seeing an acceleration in revenue growth. I'd want to see more and more evidence of those beats. Maybe partners showing even greater evidence of bigger wins. They would have to do, just a little bit more outperformance on the revenue line. I would probably start to move the target higher.
Okay, Stephanie, let's hear one of your picks.
Sure, absolutely. Maybe I'll start out with a bit of a comment on your comments around the defensive environment right now. So what we saw at the end of 2018 was that the software and services index in the TSX was the best performing index in that TSX. It was up 19% year over year. I think what you saw, though, in Q3 was that investors were getting a little worried about valuations. Right now, even after the pullback that we saw, the price to sales metrics on software and services companies are trading about 2 times the average standard deviation. So we're still, versus average, we're still a little high here. And so what you saw in Q3 was, I think, companies that had these high growth multiples, if they had a little bit of a stumble, like Connexus, you saw their stock price hit. And so within that environment, I think it's interesting. And I think when we go into 2019, what we could see is if this, volatility continues, what I think we could see is more M&A activity among the software and services companies that I've got under coverage. And so for my names for 2019, my top picks are all relatively defensive. I've shied a bit away from the growth names these days. I still like names like Connexus, love the management team, love the product, but I just worry about in this market, you've got volatility there, and those growth numbers, in one quarter could be tough, and you could see a big impact to the multiple. So in terms of the first name that I'll talk about, maybe I will talk about a name that I think is poised to benefit from the M&A environment right now, and that is Constellation Software. So Constellation, for a while, the last couple years, they have seen a real slowdown in their M&A activity. So these guys are basically a PE firm. They've got about 200 different businesses, and they basically just add these vertical market software companies, and they're typically tiny. They're typically, $10 million, and they'll go out and buy these $10 million entrepreneur-led software companies, and then roll them up and give them, correct operating metrics, tell them how much they should be spending on sales, how much they should be spending on this and that, and basically go from there. And so what you've seen in the previous environment was that it was tough for these guys to do larger deals. So they're now at $3 billion in revenue, and they had to kind of increase their average size of acquisitions. And it was tough for them. They were competing against PE firms, and these PE firms basically would lever up a lot more than Constellation was willing to. And so you saw them pause. And it was interesting because in 2018, they kind of hit the reset button, and they said, okay, we're going to increase our M&A team from 60 people to 80 people. We're going to allow our business units to go out and make these smaller acquisitions on their own without going up to head office. And so what you saw in 2018 was Constellation was actually one of the few companies in our coverage that actually increased their M&A activity in 2018. We saw it up 100% year over year. And so as you head into a better M&A environment potentially, with their staffed up M&A team, I think that they are well positioned to participate in that M&A upside. And the other thing I would note about Constellation is these guys have best in class operating metrics. So their ROIC is about 30%. Which is best in class in the software space. And these guys don't raise equity. They pay for their acquisitions primarily out of cash flow. And so we just think it's a very stable business that potentially is going to see upside if you do see these valuations start to compress.
So we've learned over the past couple of years that you shouldn't underestimate Mark Leonard. He always seems to pull a rabbit out of a hat. Do you think he can continue to do that if the environment were softer?
Yeah, absolutely. So Mark is a great operator. And it was interesting because I had a hold on this company for a long time saying, large numbers, you're not going to be able to go out there and make, 300 small $10 million acquisitions and succeed. And so he basically proved me wrong in 2018. He doubled down on the small market, increased his M&A team, and is out there doing it. So, yeah.
We have Constellations trading at $982.45 right now. It's like the Berkshire Hathaway of Canada here. What's your target on it?
So my target is actually $1,250.
$1,250.
Yeah, and so it's interesting how I get there because I think I'm a little bit different than other people on the street because I actually look at this company on a DCF basis. And I look at it on, typically they have basically used 70% of their cash flow on acquisitions each year. And so I start out at 70% of cash flow, and then I assume that percentage used on acquisition goes down about 10% a year because it's tough to go out and make these acquisitions. And so I get a DCF value of $1,250 if you add in future acquisitions.
Okay, thank you, Stephanie. Pardeep?
Hi, I'm going to take a little bit different approach. I'm not going to go the conservative route. So the way I look at the market right now is that with the downturn in the stock market end of last year, there's a lot of good value out there. There's a lot of stocks that you can go and pick off. So I'm looking for sort of bottom-up fundamental approach. Stock pickers market is I think what it's going to be. So for my top pick, we published a report in December. Acuity Ads, ticker symbol AT on the Venture Exchange. When we published a report in December, since then it's been up 40%, and since the beginning of the year it's up 23%. So Acuity Ads, a little bit about Acuity Ads. It provides targeted digital advertising solutions. They've got a programmatic advertising platform. So basically, Yeah, all of you have been to the on the websites, and what you can see is you get targeted ads every time you go on a different website, depending on where your history has been, where you've been surfing previously. Acuity Ads, sorry, Acuity Ads AT. There's
AT on the venture.
And the fellow in the front row here. So why we like Acuity Ads? First of all, they just reported last week a blockbuster quarter. The revenues were up 115% and the EBITDA up 400%. The stock's been responding very nicely since then. We find the stock is undervalued. Right now, we've got $95 million sort of revenue target for this year. They're at a $60 million market cap. So less than 1 times revenue for a company that's profitable and is generating positive EBITDA. So you don't come across those types of valuations very often in the software and technology space. Overall, we see this continued growth of the digital advertising market, which will keep revenues keep on going for Acuity Ads. And we just see that the company keeps on executing right now, and we see some good growth ahead.
Acuity Ads is trading at $1.42 right now. I know you just raised your target. What is your target?
So it's $3.25. So over 100% upside is what we're predicting on this stock.
Okay. Kevin, lightning round? No, I'm just kidding. Let's go back to another pick from Kevin Krishnaratne.
Okay, I'll go smaller cap this time on hardware. I'll pick a stock, Baylin Technologies, the ticker BYL. This is a great way, I think, for investors to play the wireless CapEx infrastructure investment cycle that's about to hit. What Baylin does, they design antennas. So their antennas find themselves into the network devices, network architecture of carriers like AT&T, Verizon, Rogers, Bell, and Telus. Historically, Baylin had its history with Samsung. 80% of the revenue used to be for antennas in Samsung phones. That's kind of flipped around, and now only 25% of their business is mobile. So they've really diversified their business, and I really like that. For 2019, what I'm really excited about really relates to wireless infrastructure architecture bills that are coming. The first trend to look for is something called densification. Now in North America, all the wireless carriers have already rolled out 4G LTE. That's already happened. But what you're seeing now are these companies like AT&T and Verizon are starting to make the networks more dense. That means basically in a given area, making sure that consumers have more and more capacity. They do that using things called small cells, which are basically mini base stations. Baylin's antennas do find themselves into these devices. They are the market leader in North America for small cell, and typically you'll find these in building, in very dense urban corridors, just as a way to get the signals right to the consumers at all times so that you never have a dropped call.
Baylin was kind of touch and go there for a while, a couple of years back. What was going on, and why is it rebounded?
Well, the rebound came from they've restructured, they've done a good cleanup job, they've transferred, made a strategic decision to go more into the infrastructure side of things, as opposed to being reliant on smartphone, which obviously that's a very tough business and a very commodity-like business. The markets that they're in right now are a lot less commodity, and they've also last year my second point, the next trend that I'm looking for relates to 5G rollout. So 5G wireless technologies are coming. It's very early days. AT&T and Verizon are starting the bills right now. In fact, this morning Verizon announced its guidance for 2019 that is going to start to see the commercial launch of 5G in 2019. Baylin is positioned to deliver the antennas for these base stations as well. What Baylin did last year is they bought a couple of assets in Montreal that gave them technology and expertise in 5G frequencies up in the 24 gigahertz and 38 gigahertz range. These are very important frequencies for the next 5G cycle, and Baylin has an advantage there. Its other competitors that it competes with don't have that expertise.
I should mention that Baylin and Acuity Ads are both here with booths, so you can talk to management if you want. Kevin, we've got 387 on Baylin, which is TSX BYL. What's your target on that one?
575.
570?
575.
Okay. Stephanie, let's go with your pick number 2.
Sure. So my pick number 2 is a bit of the opposite end of the spectrum. My second pick is CGI. So the ticker is GIBA, GIB.A. on the TSX. So CGI is interesting because it is obviously the behemoth in the Canadian tech space. These guys, though, are outperforming their peers. So when you look at their book-to-bill over the last couple quarters, it's been well above 1 and well above Accenture and Capgemini and some of their other competitors. And so they're seeing organic growth from a couple of places. One is their metro market tuck-in strategy that they've been doing has been giving them consultants that can then cross-sell in additional services that CGI offers. So think outsourcing, think software. And so that's driving some growth, and obviously the overall market. I mean, when you look at the overall market, fundamentally, we're seeing a strong tech market right now. So overall, the global software space is expected to grow in the 9% range in 2019. And CGI is benefiting from it. So if you think about blockchain, if you think about analytics, think about big data, if you think about AI, the first people that a company is going to call up if they're interested in using these is a IT services company like CGI. So organically, CGI is growing well. I think the more interesting part about CGI is their free cash flow. So CGI's free cash flow this year is expected to be $1.6 billion. And so, they've obviously got a lot of cash to spend. So what they did last year was they bought back shares. They bought back about 700 million shares. And they made acquisitions. So they made these metro market tuck-in acquisitions, which basically, they're buying little consulting firms, and these little consulting firms have 1 or 2 big clients. And so they would use these consulting firms to then get into these larger clients and cross-sell software solutions, cross-sell outsourcing solutions, and build the market from there. With $1.6 billion in cash flow, we think they can continue to do that. We also think there's the opportunity that maybe they offer a dividend. They're one of the only large cap Canadian stocks that don't offer a dividend here. And with that type of cash flow, in the past they've said we'd prefer to spend it on growth activities. But when you get to a certain size, I think that you start to rethink that decision. And the other reason we like CGI, there's the stable part of the business. I think the upside for these guys potentially is a transformational acquisition. So you typically see them do a transformational deal kind of every 5 years. Logico was their last one. And they've been focusing on the metro markets acquisitions, I think because valuations have been too tough on these larger deals. And so if valuations are potentially coming down, potentially you see them going out and making a larger transaction. And if they were to lever up to 4 times, similar to what they did with Logica, we think they could spend $7 billion.
I would have thought of CGI as the very definition of a defensive technology stock. Is there any chance that the government shutdown in the U.S. is a concern?
Yeah, it's a great question. So they do have a federal part of the business. CGI's U.S. business itself is about 30% of their overall revenue. 90% of that federal business is mission critical or user pay. So think things like cybersecurity, think things like IT. And on the user pay side, they do visa processing for the U.S. State Department. So those solutions, those issues, it's not going to be an issue in terms of the government shutdown. On that other 10%, potentially it's a cash flow issue. So if the government's shut down, nobody's getting paid.
Pardeep, let's go with your pick number 2. The ticker symbol on CGI Group is GIB.A.
Thanks, Nick. So once again, I'm going to go the opposite end of Stephanie, from billions and billions of dollar market cap to something that's a $35 million market cap company. So as you can see here, a lot of the companies presenting at the show here are micro cap companies, and everybody likes a stock that nobody's watching, something that's under the radar. So I'm going to give you something that's not covered by any tech analysts or anybody that's covering it right now, and that's a company called Well Health Technologies. That's ticker symbol WELL on the venture exchange, Well. So why we like Well, and what does Well do? First of all, Well is right now the largest provider of primary healthcare clinics in British Columbia. They've got 19 healthcare clinics. You guys have all been to your family doctor, and it's a bit of a mess. You got to sit around waiting in the waiting room for a couple hours. There's very little technology involved. What Well is doing is it's marrying health clinics with technology. They're also going out there and acquiring technology companies. They just made an acquisition of an electronic medical health records company, which will automate the electric health records inside those health clinics. In addition, they want to add things like online booking. They want to add virtual care. They want to add a lot of technology into your visit to the doctor and make that a technological visit. Right now we have all these electronic devices or mobile devices, and we can do a lot on those, but we don't use any of that to do our visits with the doctors. And on the medical side, the whole technology is living back in the 1980s. So why we like Well Health? first of all, it is a huge market opportunity. Second of all, we like the management team. So this is a repeat entrepreneur, Hamish Abazi. He previously sold his previous company, TU Networks, for over $300 million. So we like to follow somebody who's experienced management, serial entrepreneur. It's also backed by Hong Kong billionaire Li Ka-shing, who's also put some money into this venture as well. So we got a really strong team with really strong backers behind it. And we think that the growth right now has been really strong. The company has basically grown from 0 revenue to 30 million revenue in basically 18 months. So we can see that growth continuing as they consolidate both the healthcare clinics as well as technologies that are going to bring the healthcare clinics into the modern day era.
This is the first disclaimer I'll have to use here. Well Health is my largest personal position. The ticker symbol is Well on WELL on the venture. You haven't launched coverage of Well.
There are no analysts covering Well right now.
Okay, thanks. Kevin, let's go with your third and final pick.
Okay, I'll go super non-defensive with my last one and pick Shopify. Ticker is SHOP. This is obviously quite a volatile stock, and it will get whacked if the market does turn. It's shown to be it's done that in the past. I really do like it, though. I think of all the names, it has the highest likelihood to continue to beat revenue expectations that the street has. The reason behind that is it's just such a wide open space for them. They don't even have 1 million merchants yet. I think I'm predicting them to have that by the end of this year, 2019. And in their core markets, they have a potential TAM of about 10 million merchants to hit. These are small businesses and entrepreneurs. That doesn't include even the big brands that they also have. And if you start thinking about going beyond their core markets into international markets, which is something that I think you're going to start to see more and more of in 2019, that further expands their TAM. So there's just so much potential for them to grab market share from small merchants and big brands. The other thing that I think that you're going to see are it's very interesting to note that more than 50% of Shopify's revenue does not come from subscription plans that it sells. It comes from other merchant solutions such as payments, processing, shipping, and capital. And so I do think you're going to see more of those services added over the coming year. The final point that I'll make, it's not on valuation, but if we do go into a recessionary market, I think that the business model of Shopify is resilient, because what it will do is it'll inspire people to kind of take a second job, try to build a website, try to build another business. So I think that the business model can actually benefit in this type of a market.
Is your target in US or Canadian dollars?
It's a Canadian 170.
Okay, Shopify is currently trading at 207, so Canadian. Okay, Stephanie, we've got pick number 3 from you.
Sure. So my pick number 3 is the exact opposite. I've saved my most defensive for last. So my last top pick is OpenText. So OpenText is a software name. It's trading at 9.3 times 2020 EBITDA. The peers are trading at 15 times. So this is one that I would say is undervalued within the market. And in this kind of volatile market, I think that is interesting in and of itself. The business itself, though, is growing. So the business, they saw 2% organic growth in fiscal 18, and they are now the largest provider of enterprise content management software. They recently acquired a company called ECD that bumped them up ahead of IBM as the largest in the space. So we see this as a good position for these guys to go out and cross-sell additional services into this customer base. They also are looking at aggressively increasing their margins, and this is one where they have scale. So they are the largest enterprise content manager out there. They can continue to drive that scale as they add new customers, and so they're looking at 38 to 40% margins by the end of 2021, and they're looking at $1 billion in operating cash flow. So this is a name that it's got good metrics, it's got a low valuation, and this is one where you can also see some significant M&A upside. So in terms of M&A, analyst models do not add in future M&A into OpenText. And what you've seen is they typically spend about $300 million a year on tuck-in acquisitions, and sometimes they go out and do a large acquisition like ECD. So I think there's upside, and if you kind of present value that $300 million, similar to what we do with OpenText, you get about $5 a share just from future acquisitions that we don't believe is in the stock right now. The other thing I would say about the name is, given its low leverage, low valuation, good margins, I think that it is potentially something that private equity takes a look at. And we think that private equity could spend up to about $51 US on the name, just given, a DCF and LBO valuation.
Why do you say that OpenText is the most defensive of your picks?
In terms of valuation. So when you think about the markets and the volatility you're seeing in the market, I don't think that the market is really building in much growth for OpenText. So,
do you think OpenText management is now committed to growth through M&A? It's traditionally been how they've grown, and they tried to work in a story of more organic growth, and that with mixed results.
Yeah.
Do you think they're now committed to an M&A? I mean, are they going Constellation?
Yeah, so I don't think they're going Constellation route. I think they've actually started basically documenting organic growth, which they've never done in the past. In the past, you kind of had to figure it out. They're now giving you a yearly number. So I do think that organic growth is still important to them. I think you're right. They've realized that they can't grow at the 8 to 10% the market's growing at, just given the prior mature acquisitions that they've done that are maybe, they paid a good price for them, they're good cash flow generators, but maybe they aren't as quickly growing as some of the other names out there.
OpenText is OTEX on the TSX. It's currently trading at $47.13. What's your target, Stephanie?
So our targets in US dollars is $50. $50
US, okay. Pardeep, last pick of the day for you.
Yeah, so the previous two were very small microcap companies. I'm going to go a little bit bigger, not as big as Stephanie here, but the third pick basically is Solium Capital, ticker symbol SUM on the Toronto Stock Exchange. It's about a $700 million market cap company, so I'm trying to keep it under $1 billion in terms of market cap picks here. So Solium Capital, what they do, they manage employee incentive and plans for corporations and employees. So the top 70 of the top 100 TSX companies, they use Solium Capital software platform to manage employee share option plans, manage employee purchase plans. So that's huge penetration just in the Canadian market, for example. A few years ago, they expanded into the US market. Last year, they announced 2 big contracts, one with Morgan Stanley and one with UBS. Those contracts are currently about halfway through in terms of their rollouts. We continue to see growth from those contracts going into 2019. So that's why we like Solium Capital. It's got a very high sticky margin business, lots of recurring revenue, and customers that don't go away.
Solium, as Pardeep mentioned, is SUM on the Toronto Stock Exchange. It's trading at $13.14 right now. What's your target, Pardeep?
Our target's $17.
$17. Okay, thanks everybody. We're going to come right back with a same kind of panel, but with fund managers. So please give a big hand to all our analysts.